Happy Friday, everybody. Welcome aboard. Welcome to our final webinar outlook for the 2011. My name is Ilian Yotov. I am the founder of the Quarters Theory, also the founder of allthingsforex.com and tradertape.com, a couple of financial websites, and also the host of the popular All Things Forex daily broadcast. You're welcome to listen to the All Things Forex program Monday through Friday on allthingsforex.com. It is also syndicated on fxstreet.com and a ton of other websites. Speaking about fxstreet.com, in this final webinar for 2011, I wanted to thank our friends there at fxstreet.com for putting together the series of webinars. Thank you so much, guys, and I look forward to continuing in 2012. Now, today we're going to discuss the first trading week of 2012, the week of January 2nd to the 6th. Lots of important economic data is going to kickstart the new trading month, the new trading year. And next week, we're going to focus on comparing the economic data from the United States and the Eurozone and looking at the consensus forecasts for the upcoming economic reports. I think that more and more traders next week will begin to see the stark differences in economic conditions in both of these economies, the United States and the Eurozone. A sequence of important economic data is due next week from the Eurozone, from the United States, and also a couple of reports are going to put the spotlight as well on the Swiss franc, as the euro, the US dollar, and the Swiss francs will be the currencies to watch, in my opinion, in the first trading week of 2012. The very first spotlight event that I have chosen to watch next week will come on Monday, despite of the fact that it's going to be a bank holiday. A lot of banks and institutions will be closed on Monday in observance of the New Year's holiday. We're going to see on Monday morning at 4 a.m. Eastern Time the Eurozone Manufacturing Purchasing Managers Index. This is the final reading, which is expected to be confirmed at 46.9. Now, why is that important to watch? It's important because the Manufacturing Purchasing Managers Index and later on in the week the Services Purchasing Managers Indexes are leading indicators of economic conditions in the manufacturing and the services sectors of the U.S. economy and of the Eurozone economy, and the U.S. economy as well, because we're going to see the same identical releases from the United States next week as well. But when it comes to the Eurozone, we already know that there are some forecasts that the Eurozone economy may already be in what Mario Draghi, the new European Central Bank president, warned that it could be a mild recession that could start as early as the fourth quarter of 2011. And we're winding down the year, we're winding down the fourth quarter of 2011, and certainly in the last several months, we have seen a lot of weakness in our Eurozone economic data. And the Manufacturing Purchasing Managers Index is expected, although climbing a little bit higher from 46.4 to a reading of 46.9 is the forecast for Monday's report, it is still going to stay below 50. Which, when it comes to the purchasing managers indexes, you know that is the dividing line between economic contraction and expansion. So the manufacturing industries in manufacturing sector in the Eurozone is expected to contract for yet another month, according to the consensus forecast. On the other hand, as I said earlier, next week is going to give us an opportunity to compare the U.S. and Eurozone economic conditions. And on Tuesday morning, from the United States, we're going to see the similar report from the Institute for Supply Management with their Manufacturing Purchasing Managers Index. Obviously, a leading indicator of economic conditions in the U.S., which gives you an idea of activity of purchasing managers in the manufacturing sector of the U.S. economy. Now, compare that with the Eurozone manufacturing sector, which is expected to contract for another month with a reading of 46.9. The consensus forecast for the U.S. Purchasing Managers Index next week is for a reading of 53.3, above 50 for another month in expansion territory, and also a little bit higher than the reading of 52.7 in the previous month. there you go. With the first two reports, we can already see engage the conditions in those two large economies. And as we have witnessed pretty much throughout the fourth quarter of 2011, the U.S. economy and economic data has shown a lot more strength and resilience compared with that of the Eurozone. And that could continue to be the trend that could be confirmed throughout next week. Also next week on Tuesday, we're going to keep an eye on the Federal Open Market Committee meeting minutes. That is the record of the Fed's previous meeting. I'm not expecting any surprises from these meeting minutes report, but it's always a good idea to pay attention to the minutes report to get an idea of what the future's outlook on monetary policy and economic outlook is. Obviously, the Fed is being very transparent. We already know where they stand. They have committed to keeping rates low until mid-2013 at least. They are also still keeping the door open to the so-called QE number 3, another round of asset purchases or quantitative easing. However, now that we've seen these signs of improvement in the fourth quarter of 2011 from the U.S. economic data, if the U.S. data continues to improve and the economy continues to show strength, then that would reduce the odds of the Fed resorting to another round of quantitative easing, or QE number 3, which of course would mean further debasement of the U.S. dollar if the Fed were to embark on additional quantitative easing, and that could weigh on the U.S. currency. However, if the data improves, that reduces the odds of QE number 3, and ultimately the U.S. dollar could start finding some more strength in expectations that the Fed is going to keep QE number 3 on the back burner for now. Although they have said previously that it is going to be ready to be deployed if U.S. economic conditions deteriorate or if the Eurozone debt crisis takes a turn for the worse. I'm not excluding the potential for QE number 3 in 2012, but as long as the U.S. economic data improves, as I said earlier, we're going to see that being put on the back burner, at least for the time being. And that's also important to watch heading into the new year and heading into the first trading month of the year, as we're also going to look for the two central banks, the European Central Bank interest rate announcement Thursday after next, and then the Federal Reserve's interest rate announcement and monetary policy meeting on January 24th and 25th. So we're going to gauge not only the U.S. economic data and the Eurozone economic data and compare both of them, but also use that information in order to gauge what the next move by the Federal Reserve and the European Central Bank could be. And I would not be surprised if the trend continues, which has been the trend throughout the fourth quarter, continues into the first quarter of 2011, and that trend is Eurozone weakness and a slowdown compared with a more resilient U.S. economy. I would not be surprised also if the Fed continues to refrain from QE number 3, while the European Central Bank actually considers further interest rate cuts in order to stimulate economic growth in the Eurozone, which a lot of countries there are embarking on some record austerity programs that obviously is not going to be very beneficial for economic growth. So now that you know the economic fundamental backdrop for both of these currencies, the euro and the U.S. dollar, let's take a quick look at the daily chart of the euro-dollar pair to see what the latest trend developments have been with that currency pair's exchange rate. Obviously, many of you know yesterday the euro broke below $1.2872. That was the level that I said we could very quickly test. Last Friday on this webinar, I said that if the euro were to break below the lows of last week, remember that line that I put here for the support level from last week at $1.2944, said very quickly we could see the euro-dollar pair testing the 2011 low from January of 2011 at the $1.2872. Well, that level was broken below yesterday, and the euro-dollar pair reached as low as $1.2857. And that obviously is a new low for 2011. Literally in the final trading hours of 2011, the euro-dollar pair did that. And earlier on my program, the All Things Forex broadcast, I took my listeners back to 2008. So when we take a look at the multi-year trend, and again, do not get me wrong here, I'm not talking the last several days or last several months. I'm talking about pretty much the last decade of trading for the euro-dollar exchange rate. When we take a look at the trend for the euro in the last decade, pretty much for the majority of the last decade, the euro has been in a strong bullish uptrend versus the US dollar. There is no denying of that. But in recent years, there is also no denying that the euro is beginning to lose that upward momentum. And when we take a look at the basic definition of an up and down trend, uptrend, obviously, you got to have higher highs and higher lows. If the euro is faltering in the last couple of years to produce higher highs, and it's now also beginning to produce lower lows compared to other previous lows, given the fact that the January low was now broken below, we have a new low for 2011, which is not lower than the low of 2010, not yet. But if it does in the months ahead, in 2012, we also see not only the euro producing lower highs, which is the first signs that I've been talking about throughout 2011, and pretty much throughout, at the end at least, the second half of 2010 on my programs, I've been talking about the early warning signs of a reversal attempt, at least, for the euro to reverse that strong multi-year bullish trend in the last decade versus the US dollar. Just to refresh your memories, in July of 2008, the euro reached a new record low versus the US dollar at the $1.6036. And since then, that was in July of 2008. In 2009, the euro failed to break above that level, to produce a higher high. Every new high for the next several years after July 2008 high above $1.06 has been lower for the euro-dollar exchange rate. That is the example that I wanted to give you when I talk about the signs of a reversal of that multi-year bullish trend for the single currency. When we take a look at these last several years and what has been happening as far as multi-year trend developments, I don't think that there is an argument there to make that the euro-dollar strong bullish trend throughout the last decade is beginning to lose momentum and start showing signs of a reversal. That is what we're going to watch heading into 2012. Will the euro not only now start producing lower highs, but also starting to make lower lows? And certainly what we're witnessing here as of yesterday is a new low for 2011, and we're going to watch the lows of 2010 as well. Lows that were established around $1.23.28, if I'm not mistaken, was a previous low. Now that the euro is heading into the $1.20s, 1,000 pip range transition that I've been talking about in the last several weeks on this program, as the euro is breaking below $1.30, which is an important price level in my quarters theory. I call it a major whole number, a major large quarter point, an important junction that divides the two 1,000 pip ranges between the $1.30s and the $1.20s. In other words, the 1,000 pip range between $1.30 and the $1.40, and the 1,000 pip range below between $1.20 and the $1.30. In recent weeks, we're starting to see the signs of transition that the euro-dollar exchange rate is making an attempt to produce, a transition from the $1.30s into the $1.20s 1,000 pip range. And if this transition is successful, and if the euro-dollar pair does move lower to those previous lows around $1.23.28, and those support levels, multi-year support levels, are broken below there, it's an area between $1.24.5 and $1.23.28 that if the euro-dollar pair were to break below it, then it could even drop not only to complete the entire 1,000 pip range that it's transitioning into, the $1.20s. Of course, because the euro is dropping from the $1.30s into the $1.20s, it will be completed from top to bottom, from $1.30 to $1.20. If there is such completion, and especially if the euro advances into the new 1,000 pip range, targets the $1.23.28 area of support, breaks below it, then we could see a completion of the entire 1,000 pip range. But not only that, perhaps with that multi-year trend reversal that is we're starting to see here in the last couple of years, we could possibly even see the euro-dollar pair moving into what has been estimated to be the so-called fair value range for the euro-dollar exchange rate, which is between $1.15 and $1.20. And you might recall that a couple of years ago, the euro-dollar pair found support within that range, with a low established at $1.2875. And if I'm not mistaken, that low was established in 2010 in light of the financial crisis and the Eurozone debt crisis that began there. So Italy, Ireland, and Portugal asking for bailouts. The euro did find support at $1.1875, so at that time, that level could be tested provided that economic conditions in the Eurozone continue to deteriorate, provided the European Central Bank does cut interest rates further, which is a possibility in my opinion, and provided that the Fed continues to refrain from QE number 3 and avoids further debasement of the U.S. currency and the U.S. economy continues to show strength, growth, and resilience. And if you want to add to that, if risk aversion continues to weigh on the euro, on investors remaining unconvinced that the Eurozone debt crisis is far from over, all of these are factors to watch that could come together as a perfect storm to accelerate the euro's decline into the new 1,000 pip range, the $1.20s. And from a technical perspective, if the $1.2328 support is broken below and then the $1.20s 1,000 pip range is successfully completed, I would not be surprised if the euro challenges the multi-year support level at the $1.1875. And maybe at that point we'll see if it finds support once again at that level or somewhere within its fair value range in between $1.15 and $1.20. Now, those are all developments that may not happen in the next 2 days. I'm talking about a larger multi-year perspective, perhaps throughout 2011. This is a possible trend development scenario for the euro-dollar pair that we have to be aware of as we begin the new year. We're winding down the final trading session today of 2011, and we're already looking at the first trading session next Tuesday. Continuing with the major spotlight economic events for next week, we're also going to pay close attention on Wednesday at the Eurozone Services Purchasing Managers Index, yet another gauge of economic conditions in the Eurozone's services sector of the economy there. Another gauge there, another Purchasing Managers Index that could stay below 50 in contraction territory. The consensus forecasts expect a reading of 48.3, another confirmation that the services sector of the Eurozone economy was in contraction territory for another month, adding to the factors to watch that I explained earlier. Also on Wednesday morning, another important Eurozone economic report with the flash, which is a preliminary estimate of the harmonized index of consumer prices. This is the preferred gauge of inflation by the European Central Bank. More than likely, that report, and the reason why I put it in a list of top 10 events to watch for next week, is because despite of the fact that inflationary pressures have spiked to 3% in the last few months in the Eurozone, the European Central Bank new president quickly undid the previous two hikes by the previous president, Jean-Claude Trichet. Mario Draghi was very quick in the last couple of months to undo the two hikes by Trichet, which was, in my opinion, the right thing to do as the Eurozone economic conditions were deteriorating. And so, despite of the spike in inflationary pressure, something that was the legacy of Trichet, fighting inflation and maintaining price stability, it was more than obvious that with the new president, as I have been saying all along for months during that time, pretty much if you listen to these programs regularly, you could go back as late as August of last summer that I started talking on this webinar about the potential for the European Central Bank when the shift happens, when the new president takes over, that the European Central Bank would potentially consider cutting rates. And that certainly has been the case. And that certainly could continue to be the case, as I said earlier, as long as the Eurozone conditions continue to deteriorate and as long as the European debt crisis remains far from over and borrowing costs continue to rise in Italy and Spain, the two large economies that are now dragged into the epicenter of the crisis. By the way, yesterday's Italian auction, some of them may have said, well, the auctions this week from Italy were successful. They raised almost 20 billion euros. If you take a look at borrowing costs, however, for their benchmark 10-year bonds in Italy, they're still at 7%, a little bit above even, 7.03%, if I'm not mistaken, as of yesterday. So the auctions, and also yesterday, one of the auctions did not raise as much as the Treasury of Italy was expecting. They raised about 7 billion. 8.5 billion is what they were hoping to raise. And now there's massive funding needs that are going to be a big concern heading into 2012, especially the early months of 2012. I think if I'm not mistaken, Italy must raise about almost €500 billion euros in 2012, or at least in the first quarter of 2012. So obviously, the reason I'm saying all of these things is to give you an example that the debt crisis is far from over. The French president is going to meet in Berlin with the German chancellor again on January the 9th. And we'll see what comes out of that ahead of the next European Union summit. 5 European Union summits here in the last couple of years have failed to contain the crisis, to stop it. So in 2012, the Eurozone definitely is going to remain in the center of the market's attention. And the Eurozone, the future monetary policies of the European Central Bank are also going to be one of the main things we're going to watch for, especially as Thursday after next Thursday, we're going to see the European Central Bank's interest rate announcement. The markets will gauge the data throughout next week, not only to compare economic conditions in the Eurozone and the rest of the world, in particular also the United States, and recognize the sign of weakness in the Eurozone, but also based on that, what would be the next move by the European Central Bank a couple of weeks from now? And as I said earlier, I'm not excluding the potential for the European Central Bank to consider further interest rate cuts. And inflation, with that flash harmonized index of consumer prices, obviously, despite of the spike, it has not been an issue. It has not stopped the European Central Bank from cutting rates a couple of times, undoing the previous 2 interest rate hikes. And the Eurozone flash harmonized index of consumer prices for next Wednesday morning's report is also expected to not be an issue. As a matter of fact, it is expected to show inflation pressures beginning to subside a little bit from the 3% increase year over year to 2.8% year over year. Another factor to watch there that could confirm that the European Central Bank inflation, if inflation pressures are not rising, that could allow the European Central Bank policymakers to feel more comfortable as far as further interest rate cuts. Another important report on Thursday, which normally comes out on Wednesday, but because of the Monday being a day off, because of the New Year's, that report has been moved to Thursday. It usually comes on Wednesdays at 8:15 a.m. Eastern Time, a couple of days before the non-farm payrolls report every Friday, first Friday of the month generally. What I'm referring to is the ADP Employment Report, and that's the automatic data processing private sector payrolls jobs creation. It's used as a measure of jobs creation in the private sector of the U.S. economy, sort of like a prelude, if you will, to the non-farm payrolls report on Friday. It is a report that we're going to watch to see what the private sector jobs creation was. More than likely, the consensus forecasts are expecting another positive month of the U.S. economy and a private sector, adding as much as 175,000 new payrolls, which would be a little bit less than the 206,000 in the previous month. But we certainly, throughout the fourth quarter of 2011, have seen the signs of improvement from the U.S. jobs market. Some would argue, well, you know, it's not real. I don't care if the government's fudging numbers or what have you. Some, you know, pessimists would say that. I'm going by what the reports are telling us, relying on the numbers that have been reported throughout the fourth quarter. There are signs of improvement in the U.S. labor market. If you recall, last summer we had some dismal non-farm payrolls reports. The U.S. economy was not creating jobs, and we certainly have seen that trend changing throughout the fourth quarter. Now, the unemployment rate was even headed lower from 9% to 8.6%. Private sector jobs creation, obviously very important. If that continues to be positive and stays within that range, close to 200,000, I think that this could be a good leading indicator of the non-farm payrolls report on Friday. Jobless claims have been improving throughout 2011. If you listen to this program, you know that I've been talking about 375,000 when it comes to jobless claims. 375,000 was the number to use as a leading indicator. If jobless claims were to drop below 375,000, that's a good leading indicator, according to economists, that it might show future improvement in the U.S. labor market. And certainly in the last few weeks, we have seen jobless claims dropping below 375,000. First, a couple of weeks ago, we saw 366,000, then 364,000. Now, yesterday, the report came for last week, which showed the jobless claims increasing to 381,000. However, the 4-week average now was at 375,000, another positive sign. That was the best reading, by the way, for the last year or so. The year of recovery, as 2011 was named, and it was the fourth straight decline for the 4th-week average and the 8th decline in the last 9 weeks. There is no denying, I don't think, that there is an improvement there when it comes to jobless claims. When you look at the non-farm payrolls, the latest employment report, there's also improvement in the numbers. That has to continue to be the trend in order for the Fed to keep the QE number 3 on the back burner, as I said earlier. And that's what we're going to watch these employment reports for next week. Not only to see if the U.S. economy and jobs market is showing signs of improvement, but also to gauge the next move by the Federal Reserve ahead of their meeting on January 24th and 25th. So the ADP Employment Report is expected to be positive for another month. The U.S. ISM Non-Manufacturing Purchasing Managers Index is due also on Thursday. Another comparison there with the Services Index in the Eurozone, I said on Wednesday, shows another month below 50 in contraction territory, while the U.S. Services Purchasing Managers Index stays above 50 in expansion territory with a reading of 53.1 compared with a reading of 52 in the previous month. Another opportunity to gauge the stark differences in U.S. and Eurozone economic conditions. And that's going to lead us to another important report that I have chosen to put on the calendar, the Swiss Consumer Price Index, the main measure of inflation preferred by the Swiss National Bank. In the last several months, we have seen the Swiss Consumer Price Index dropping below 0%. What that means is it's heading into deflation territory, and that deflation is beginning to become a threat once again for the Swiss economy. The reason why this report is going to be important is because the Swiss National Bank on September the 6th has resorted to a historic measure for a second time ever since 1978, when they pegged the Deutsche Mark to the Swiss franc and established a floor for the Deutsche Mark versus the Swiss franc. They have done this only for a second time in their history on September the 6th of this year, by establishing a floor this time for the euro versus the Swiss franc. And that floor is 1.20. Since that floor was established, the euro-Swiss franc exchange rate, and I will switch us very quickly over to the daily chart of the euro versus the Swiss franc, definitely a currency pair to watch as we head into next week and head into 2012. As we have not seeing the euro being capable, as I called it, of standing on its own feet versus the Swiss franc. These are the same support and resistance levels that established the channel where the euro-Swiss franc exchange rate has been trading within for the entire fourth quarter of 2011. And is pretty much a range and a channel that's being established between two important price levels in my quarters theory, which would be 1.20 and a large quarter point at 1.25, with the euro finding support at 1.2022 on September the 14th and resistance at 1.2472 on October the 19th. This is the range where the euro-Swiss franc exchange rate has been fluctuating within. The Swiss National Bank, in their recent monetary policy assessments and outlooks, have said that even at these levels, even after they raised the floor and established the floor at 1.20 for the euro-Swiss, the Swiss franc is still, even at these levels, the Swiss franc is still massively overvalued. And they're expecting it to continue to decline in a long run. However, the euro has not been capable of strengthening beyond the top of this range on its own. As I said, since September, it has been fluctuating in that range between roughly 1.20 and 1.25 Swiss francs. Most recently, the euro made attempts a couple of weeks ago again to challenge the top of this range, but it was not successful as far as breaking above it. It slowly but surely began to trail lower. The Swiss National Bank's interest rate announcement came out. They did nothing as far as additional measures to weaken the Swiss franc, which was normal, as I explained. It's not unusual to see them at the end of the year and not risking to do anything, but rather allow another month or so to see what happens there with the Eurozone debt crisis, with the economy and so forth and so on. But it's more than obvious that the euro is not capable of strengthening on its own, of breaking above and beyond that range. On the other hand, we are starting to see deflation becoming a threat, and next week's consumer price index report is expected to show us exactly that, with the consumer price index dropping again by 0.1% as the consensus forecast. It would be a little bit of a smaller than a 0.2% month-over-month decline that we saw in the previous month. But even with minus 0.1% month-over-month, the year-over-year level could be about minus 0.4 reading year-over-year, which is still below 0%, which still means that deflation is a problem. And if you recall a couple of years ago, the deflationary pressures building up in the Swiss economy were one of the main reasons as to why the Swiss National Bank decided a couple of years ago to produce not one, but multiple interventions attempting to curb the strength of their currency. Of course, the interventions were not successful. We actually saw earlier this year the euro-Swiss franc exchange rate dropping almost to parity, finding support about 67 pips above the parity level between the euro and the Swiss. And so now the deflationary pressures are beginning to build again. Now that the largest trading partner of Switzerland, the Swiss economy, which is the Eurozone's economy, is slowing, which ultimately takes its toll on the Swiss economy. Strong Swiss franc also taking toll on the Swiss economy in the third and possibly in the fourth quarter, which the GDP reports for the fourth quarter will start coming out in January next month. So the economy is slowing. Swiss franc still strong, taking toll on the economy. The Eurozone economy contracting, possibly going through a mild recession, which would have a negative impact on the Swiss economy. The Swiss National Bank seeing deflationary pressures building up and becoming a problem once again. And on top of that, the euro being unable to strengthen further on its own versus the Swiss franc. You have to add all of these factors together, and I have been making for the last month or two the argument that I would not be surprised heading into 2012 if that continues to be the underlying fundamental backdrop. If the Swiss National Bank is forced into giving into the political pressure, which there is also political pressure in Switzerland from politicians and the government on the Swiss National Bank to do something more to weaken the Swiss franc further. Finally, I think given these circumstances and factors, I would not be surprised heading into 2012 if the Swiss National Bank decides to do something more. And that could include possibly a more bold type of a decision, which could include raising the floor from 1.20 to 1.30. Now, some strategists there at UBS, if I'm not mistaken, were forecasting that the Swiss National Bank might raise the floor from 1.20 to 1.25. I don't think that that's that type of a bold move, really, because the euro has already been testing or at least approaching 1.25 on its own, but it's incapable to strengthen beyond it. And if the Swiss National Bank really wants to produce a bold move, it has to be a move of raising the floor to at least 1.30. Now, in a final month of the year, as the year winds down, they weren't willing to do that. But if conditions continue to deteriorate, I think that one could really make the argument, as I have been in the last month or so, that it may be only a matter of time before they give in to political pressure and decide to do something more, possibly a bolder move and an increase of raising the floor. That is why also we're going to keep an eye on the euro versus the Swiss franc next week. And when it comes to purely technical developments with the euro-Swiss exchange rate, it is approaching the bottom of an existing range, is getting close to the bottom of a range. Now today we're reaching as low as 1.2154, which is a move below a double bottom support here around $21.63 area, or not $21, but rather 1.2163 Swiss francs for 1 euro. A break below this level could quickly encounter support at 21.28, another double bottom support area right there. All of these numbers are closer to the bottom of, to the floor, in the bottom of the range, near 1.20. In other words, it's a range-bound trading environment, and many of you, I bet, know what to do when you have ranges. We don't look for opportunities in the middle of the ranges. We look for opportunities close to the top or close to the bottom of clearly well-established existing ranges. And that is the kind of a range that we have for the Euro-Swiss exchange rate. So now that the Euro-Swiss franc exchange rate is approaching the bottom of that range, considering all these factors that I went into detail explaining a few minutes ago, this could be an interesting currency pair to watch next week, especially ahead of the Consumer Price Index report on Friday of next week, January the 6th at 3:15 a.m. Eastern Time, and especially if the inflation gauge continues to stay below zero in deflation territory. After the Swiss Consumer Price Index next Friday, we're going to focus on the Eurozone retail sales, an important measure of consumer spending. Another economic report that would show us weakness in the Eurozone economic activity, the retail sales are expected to drop by 0.2%, a reading of minus 0.2%. And keep in mind, these are holiday shopping months. And we're seeing retail sales decline. That's not very good in my opinion. Consumer spending there is expected to contract by 0.2% month over month compared with the 0.3% increase in retail sales in the previous month. As I said earlier, yet another report that could show signs of weakness from the Eurozone economy. And then, of course, the crown jewel of all important economic data for next week, the non-farm payrolls and employment situation report is coming up next Friday at 8:30 a.m. Eastern Time. As I said earlier, throughout the fourth quarter, we have seen signs of improvement from the U.S. jobs market. The U.S. economy has been adding jobs throughout the fourth quarter, and that could continue to be the trend. The consensus forecasts are actually expecting anywhere from 140 to 155,000 new jobs to be added by the U.S. economy in the month of December. This would be if that, provided that consensus forecast is accurate, this would be another month of improvement and a stronger jobs creation than 120,000 jobs that we saw in the month of November. The only weak spot of the non-farm payrolls and employment situation report next Friday could be the unemployment rate. Some forecasters are seeing a little bit of an increase in the unemployment rate from 8.6% to 8.7%. That may not be a very strong part of the employment situation report, but if that is not the case, if the unemployment rate stays unchanged at 8.6%, and we get to see stronger jobs creation in December, then that could be yet another positive employment report from the United States, which will wrap up the sequence of important economic data and a comparison, the opportunity for a close comparison between the U.S. economy and economic conditions in the Eurozone, which will, as I also explained earlier, will help us gauge the next move by both of these central banks, the European Central Bank and the Federal Reserve. I would like to invite you to listen to my daily outlook and my daily program, the All Things Forex broadcast. You can listen Monday through Friday on allthingsforex.com. You can also follow us on Twitter at allthingsforex. At allthingsforex is the Twitter account. Thank you all very much for listening to this program on a regular basis every Friday. I'd like to thank our friends at fxstreet.com for putting together these series of webinars. Thank you all very much for listening. Have a great weekend, great New Year celebration, and I would like to wish all of you a happy, healthy, and prosperous New Year. Thank you so much. Happy New Year, and I will see you again in 2012.